18 months. That is exactly how long it took for three guys working above a pizzeria to go from uploading a 19-second clip about elephants to signing a $1.65 billion exit. Pause on that for a second. 18 months. Most startups spend longer than that just arguing about their logo. But this isn't a story about funny cat videos or viral moments or the birth of the creator economy, at least not primarily. It's a story about a burn rate so terrifying it nearly bankrupted them before they could sell. It's a story about a bidding war conducted in secret over a single frantic weekend. It's a story about three founders who built something so dangerously fast, so recklessly large, that the only rational move left was to sell it before the whole thing exploded. This is the financial thriller of how YouTube forced Google's hand. To understand the speed of this deal, you have to understand the pedigree of the founders. Chad Hurley, Steve Chen, and Jad Karim weren't just computer science students hoping for a break. They weren't dorm room dreamers with a PowerPoint and a prayer. They were soldiers from the PayPal wars, battle-hardened alumni of one of the most consequential startups in Silicon Valley history. They were members of the so-called PayPal mafia, the same informal network that would go on to produce Elon Musk, Peter Thiel, Reid Hoffman, and a generation of billion-dollar companies. These were people who had already watched a platform scale from nothing to everything at terrifying speed. They had already seen what happens when infrastructure can't keep up with demand. They knew, in their bones, that in Silicon Valley, momentum is the only currency that matters, and that momentum can turn into a liability just as fast as it becomes an asset. February 2005. The domain is registered. The first office is carved out in San Mateo, California, not in some gleaming glass tower, but literally above a Japanese restaurant and a pizzeria. The rent is cheap, the vision is not. What's striking about this early period is how uncertain everything actually was. The initial concept for the site wasn't even a video sharing platform. It was a dating site with video. The pitch was essentially, upload a clip of yourself, find a match. They called it tune in, hook up. It fails completely, not partially, not kind of. Nobody uploads a single video, not one. The founders stare at an empty platform and realize they've built the wrong thing. So they pivot. Forget the dating angle, forget the hookup premise. Just upload anything. Upload whatever you want. No rules, no categories, no agenda, just video, open to the world. It sounds almost too simple, but sometimes the simplest pivots are the ones that change everything. April 23rd, 2005. Jawed Karim, one of the three co-founders, walks up to a camera at the San Diego Zoo, stands in front of the elephant enclosure, and records himself for 19 seconds. He says the elephants have really long trunks. That's it. That's the video. It's grainy, it's awkward, there's traffic noise in the background. It is, by any aesthetic standard, completely unremarkable, and it is now one of the most historically significant uploads in the history of the internet. That clip, me at the zoo, is the first video ever posted to YouTube, but the real explosion doesn't happen in April. It happens months later, in two specific moments that nobody planned for. First, a Nike commercial featuring Ronaldinho, the Brazilian football genius, doing trick shots with a pair of golden boots. The clip wasn't uploaded by Nike. It wasn't part of a marketing campaign. It was just a fan upload, shared and reshared until it crossed 1 million views, a number that, in 2005, was almost incomprehensible for an internet video. The platform had proven it could handle a viral moment. Then came the second catalyst. Saturday Night Live broadcasts a digital short called Lazy Sunday. It's a rap sketch about going to see the Chronicles of Narnia and eating cupcakes in New York City. By any description, it sounds absurd, but it explodes. Within days, the clip has been watched millions of times on YouTube. NBC eventually forces it down for copyright reasons, which, ironically, only makes people want to find it more. Suddenly, the traffic isn't doubling every month, it's doubling every week, and this is exactly where the nightmare begins. Here is the brutal economic reality of video hosting that most people never think about. Every single view costs money, not in some abstract accounting sense, in a very literal, very immediate sense. Every time someone presses play, YouTube pays for the bandwidth to deliver that video. Every uploaded file occupies server storage. Every server generates heat, which requires cooling, which requires energy, which requires payment. Scale that by 100 million video views per day, which is what YouTube is serving by the summer of 2006, and you have a cost structure that would make a CFO weep. Industry estimates at the time suggest YouTube's bandwidth bill alone is approaching $1 million per month. Some analysts put the total operational cost even higher. The platform is, in the most clinical sense, a machine for destroying money. Sequoia Capital steps in. Roloff Botha, a South African-born investor who, not coincidentally, is also a PayPal alum, leads the funding rounds and pumps in millions. But even that capital can't keep pace with the growth. It's like throwing paper into a furnace. The more successful YouTube becomes, the faster it burns. The clock is now ticking loudly. The company isn't profitable. There is no real revenue model. The advertising infrastructure that will eventually turn YouTube into a money printer doesn't exist yet. And looming in the background, growing larger by the day, is a threat potentially more dangerous than cash burn. Copyright law, Viacom, NBC, the major record labels, Hollywood studios. All of them watching YouTube's traffic numbers, all of them seeing their content uploaded without permission, all of them sharpening their legal knives. Billion-dollar lawsuits are not a hypothetical, they are a matter of when, not if. YouTube is a runaway train with no brakes, heading directly toward a cliff called litigation. They need cover. They need a buyer with deep pockets, a legal army, and the infrastructure to absorb the incoming fire. Enter the bidding war. It is late 2006. Yahoo is desperate. They missed the search wars. Google outmaneuvered them so completely that it was almost embarrassing. They do not intend to miss video. An offer lands on the table. The number is serious, but Google is watching everything. Google Video, the company's own internal attempt to compete in the video space, is underperforming. The product is fine, but it isn't YouTube. It doesn't have the culture, the community, the viral momentum, or the cultural cachet. Larry Page and Sergey Brin run the numbers and reach a conclusion that is as strategic as it is existential. If Yahoo acquires YouTube, Google loses the future of the web, not just a market segment, the future. Video is where attention is going. Video is where advertising dollars will follow. This acquisition isn't just an investment, it's a defensive strike. What follows is the stuff of Silicon Valley legend. The negotiation happens over a single weekend, frantic, compressed, conducted in secret at carefully chosen locations to keep the press from catching wind. The YouTube founders know their leverage. They have the asset everyone wants, and they have competing interest. They want a number that reflects not just what the company is today, but what it could become and what the legal exposure is worth absorbing. Google wants the deal closed before Yahoo can counterpunch. The number settles at $1.65 billion, paid entirely in Google stock, a staggering premium for a company that has never turned a profit and is sitting on a mountain of unresolved copyright claims. On October 9th, 2006, the deal is announced to the world. The founders, still barely believing it themselves, record a video in a parking lot, laughing and stumbling over their words. They look like three people who have just survived something, which, in a way, they have. They had taken a platform burning millions of dollars a month, navigated a legal minefield, survived a bidding war, and traded it all for a stake in the most powerful search company on earth. Google absorbs the legal blows. They fight the Viacom lawsuits for years and largely prevail. They build the advertising infrastructure. They sign the content deals. And slowly, methodically, they turn that burning platform into one of the greatest revenue-generating machines in the history of media. Today, that $1.65 billion price tag looks like a rounding error. YouTube generates tens of billions in advertising revenue every single year. It is the second largest search engine on the planet. It has reshaped music, politics, education, journalism, and entertainment. But in October 2006, it was a controlled explosion, a gamble that defined the modern internet. The PayPal mafia had struck again. Three guys above a pizzeria had proven the theorem that Silicon Valley runs on. Build fast enough, grow reckless enough, make yourself impossible to ignore, and they won't just come. They'll pay you $1 billion to own it.